Our next guest says the market lows are in. Let's bring in the man who moves the markets, JPMorgan's global head of derivatives and quantitative strategy, Marko Kolanovic. Marko, great to have you back. Good to see you. Happy New Year. So the firm's stand is 3,100 by year end.
It's actually 3,000.
3,000, excuse me, 3,000 by year end. What brings us there? And what do you think has changed? Because towards the end of last year in the fall, you were actually bullish going into year end, and it didn't pan out.
Did not work out, So sort of what happened in the Q4 was a sort of a series of shocks that were delivered to market. First in October, we had the de-risking of systematic investor, then a hedge fund, equity long-short hedge fund degrossed and reduced end of October. And things stabilized a little bit in November, and we had the G20 progress on G20 and some progress also with the Fed, which we thought should be enough actually to push the market higher. What did happen in December was really a retail mutual fund liquidation, unprecedented since 2008. So retail kind of pulled the plug in an environment where there was no liquidity. So very scary, very ugly price action in the sort of first 3 weeks of December. Really, what saved the situation in December were pension funds buying in the last week. So if you look at December on its own, it was largely driven by the flows. It was a retail investor first yanking money out of the market, and then pension funds plowing in, which basically pushed us up very quickly, back 7-8%. So December was really about the flows, and flows and positioning and complete collapse in liquidity. And liquidity is still very thin, So we did bounce back now a little bit, but we do point that positioning is still very, very low. So if you look at the equity hedge funds, their beta is less than 10 percentile historically. If we look at some of these volatility-sensitive investors like vol targeters, they're actually at the absolute low. So positioning is very low. You did have, as I mentioned, some of the pension fund bid. You had some short covering now, and even a little bit of a short covering from some of these trend investors, which kind of push us up on a very low volume where we are now at, call it 2,600 something, which is a level, end of October level and kind of early December level. So the way we look at this December was a really, as a liquidity disruption, as a market driven by flow, we do acknowledge weakening in some fundamental data and derating of earnings, but we also do think that price is incorporating that largely at this point. So you could have actually data that is maybe not stellar, but stocks that are actually drifting higher on account of some relevering and maybe some opportunistic buying.
So Marko, let's just take it back 1 year. At this time, the consensus was that we were going to have really good growth, synchronized global growth in 2018, and that was the thing that was going to get every strategist, move back up to their 3,200 or whatever the average was a year ago. So now we've had this reset, and I say to myself, okay, so now the consensus is global synchronized slowing, and I'm hard pressed to think what are the catalysts that get us back to the prior highs and above that.
So our base case is there is no recession, that we did have a slowdown, that we had a drastic delevering, and as a result, that basically central banks will turn more dovish, will put sort of hiking on pause. So we're starting from kind of very low position, we call it clean slate. Earnings did grow last year quite substantially, 20+%, and we are down 6%. So some gap did open, right? Even if we look at the small caps, earnings grow 30%, stocks were down 20% or so. So you have like 50% a margin of error for this, call it slowdown. And yes, we do recognize slowdown. And actually, the one thing that I do a little bit worry is Europe. It seems to be slowing up actually more than perhaps we were expecting. For China, we do think that there's a round of stimulus coming into that economy, and at some point it will start showing up on a positive side. And then again, we're taking a bit of a leap of faith that U.S. is not going to go to recession. We do have a slowdown, but we don't go from 3.5 to negative. We slow somewhere in the low twos, but which can still actually grow your earnings. We are adding job, and so hence. The answer to our question is there's this buffer, right, where earnings went and when the stock went. So we think there's some room for now price target. I was never a huge fan of price target. I tend to think statistically, so there's a probability we go there and probability we go there, and I still do have at the back of my mind some probability that we do go much lower, but
what is that probability in the back of your mind?
The recession kind of probability, different models, so we have in-house model that shows about 35%. There's an economic-based model, there's a market-based model, Fed model shows 25. So it's kind of, I would say my feeling we call it 25%.
What are you expecting for earnings growth in this year?
So we clearly do want to see a little bit of how the earnings season pans out, but we think mid to high single digits, for this year.
And then some multiple expansion as well?
Well, at least we think some stabilization of multiple or not further contraction. You know, maybe depends a bit on the Fed and also on the path of economy.
The volatility that we saw in the last quarter of the year, will we see that again this year, or is that a thing of the past?
You know, we will see more frequently these type of episodes. You know, and I have been writing about that for the last 5 years. You know, so kind of 2015 and February to last year, and then October and December. You know, like so. So I think these type of liquidity seizures, we'll see them, but they typically happen from the higher point of leverage, you know, like so you re-lever fairly quickly, liquidity kind of shoots up, you know, so everybody feels good, and then you immediately get slammed, liquidity disappears, systematic sellers come out and sell, option hedging programs sell, so you have these kind of little tail events, you know, like so I think we will see them, but we just saw 3 or 4 like October, December, you know, like so I think we could be in for like a little bit of a re-levering, a reloading phase, you know, like so that's why I think basically positioning is something that I think can drive market higher despite the consensus, which is very bad.
We're running out of time, Marko, but I mean, in the era of machine trading, I don't want to blame the machines. I'm not trying to fault anybody or anything for volatility, but in this day and age where you can get in and out of positions much faster than in the past, these bouts of volatility may not be surprising. And in fact, them occurring more frequently seems like that would have to be the norm at this point. You go through cycles much faster, right?
You do. You know, we used to have kind of one every 2-3 years. Now we have 2 or 3 every year. You know, like so. Unfortunately, that might be a norm given the sort of structure of liquidity. You know, electronic liquidity that can quickly, you know, pull liquidity back or provide liquidity. And some of these, you know, programmatic flows. It could be option hedging programs. It could be quants. It could be, you know, insurance industry. But a lot of things do go on autopilot.
Marko, thank you. Always good to see you. Thank you. Marko Kolanovic.
Well, to get to 3,000, and Marko does a great job, and he doesn't like price targets, so I'm going to give him that. But you know, you got to if you give S&P earnings about $160, which by the way I think is probably high this year given what we're seeing, that's a 19 multiple to get to 3,000. I don't know how you get to a 19 forward multiple in the environment that we find ourselves in. So look, can we get to 3,000? When you bet against this market, you tend to be wrong, but I have a hard time mathematically getting there.
So we've got a year-end target of 28.50. And we get to that by looking at 2020 earnings being right around $180 and the multiple expanding a little bit out to about 15.8. So we're a little shy of the 3,000 mark.
So you know what I'm left off with? You have Europe, you have Japan, and you have China teetering on what could be a recession. You have Powell, even if he stops, takes the Powell pause, QT, still running off. So you have a tightening cycle, global slowdown, recessions rampant all around the world, lower markets.